Long-term, tax-sheltered growth at high rates of return. This is how you're going to build up wealth for your retirement. I'm going to tell you a bit more about two different investment accounts you've probably heard of in today's installment of my personal finance series, the 401k and the Roth IRA, both of which are tax advantaged, meaning you get some kind of tax break when putting in or taking out money, and the income gained from these will not be taxed. Your 401k is the first place you need to start investing in order to build your retirement savings. A 401k is an investment account that you open with your employer, and you can't withdraw without penalty before you're 59 and a half. You'll be able to allocate a certain amount of your paycheck towards this 401k, and you'll usually get to pick the contributions to be either traditional or Roth. You'll probably answer some question about when you plan to retire or what your risk tolerance is, and these questions are going to change what kind of assets the account's going to be invested in. If you're in your 20s or 30s, max out the risk. We have plenty of time to bounce back from that volatility before you turn 59. Now, if you don't know the difference between traditional and Roth, traditional gives you a tax break when you put cash in, and Roth gives you that tax break when you take cash out. Both of them grow tax-free, meaning if you make money on your 401k account, you don't need to claim it on your taxes at the end of the year. Most employers will offer to match your contributions to this 401k account at a percentage of your salary. You absolutely need to take advantage of this. It's free money that you're leaving on the table if you don't at least meet the employer match. A 401k has a contribution limit as well that changes every year. In 2026, it's $24,500. You probably don't need to worry about this earlier on in your career. And to be clear, this is the limit for your contribution, not the total, which is going to include the employer match. That limit is much higher. If you're wondering whether you should go Roth or traditional in your 401k, there's a few things you need to consider. 1. Will you be paying more in taxes right now or when you withdraw? If later, then that's a point for the Roth. And 2. How much money are you contributing? If you're doing anything less than maxing the account, you'll be able to put more money in using a traditional because it's being taken out of your check before it gets taxed. It's never claimed as income. That means more money in the long run, even if you're in the same exact tax bracket. That said, if you're hitting the max contribution, it's kind of a wash, so it really depends on your situation which one's going to be more beneficial to you. If you need more money now, traditional. If you can max the account and you don't get hurt by the tax hits now, Roth. But you could, of course, just contribute 50-50, and then at worst, you're only half wrong. I'd also recommend putting your bonus, if you get one, straight into a traditional 401k. And that's another thing you're going to have to set up with your employers separate from your normal contribution. Reason being is that when you get a bonus, you're likely going to get hammered on taxes compared to your normal income. So this keeps your bonus tax-free, and you get to contribute less on each paycheck to hit the same amount of contribution for the end of the year. So in a way, you're almost sheltering your bonus and slowly getting it throughout the year via smaller contributions to the 401k from your paychecks. The only time I wouldn't recommend this is if you get a bonus large enough that it's going to lead to you not getting the full employer match because you reach the contribution limit before the end of the year. Now, I really hope you have that problem, because if you do, then you must have a pretty damn substantial bonus. Now, we're going to talk about our next account, the Roth IRA. I know you've heard about this one. It's probably the most talked about investment account online. It's essentially a brokerage account that's tax advantaged, but you can't withdraw gains without penalties until you're 59 and a half. At that point, you can withdraw tax-free. So how do you set one up? You can find a brokerage like Vanguard or Fidelity and start investing there. The only thing you need to watch out for, and I actually left some money sitting around for like 5 years because of this, is that you actually need to manually invest your money into an investment once you've added the funds. And personally, I do 80% in VOO, which is Vanguard's S&P 500 index, and 20% in VXUS, Vanguard's non-US stock index fund. Reason being, I'm in my 20s, I have plenty of time for both of these accounts to grow, VU's going to get better returns more than likely, but just in case, I have that 20% VXUS for a little bit more diversity. And of course, none of this is financial advice. This is just what I do personally. Your contribution limit is actually pretty low for a Roth IRA. So in 2026, you can only invest $7,500 annually. Of course, that's still a lot of money, but it pales in comparison to the 401k's $24,500 limit. Once you're meeting your full employer match on the 401k, this is the account you want to max first, if your goal is to build a big retirement fund. One catch is that if your adjusted gross income, or the amount of income you see on your tax returns that you get taxed on, if it's over a certain amount, so for 2026 it's $152,000 if you're filing single, sadly you cannot contribute to a Roth IRA. Directly, anyway. You actually can add funds to the IRA, just a traditional IRA, and then move them to a Roth through something called a backdoor Roth IRA. Now that's a bit beyond the scope of this video, but I thought I'd mention it. Now you can't withdraw from a Roth IRA until you're 59 and a half without having some big penalties, with one notable exception. You can actually withdraw contributions with no immediate penalty. The only catch is, once the money's out, you don't just get more space in your contribution limit. So if you max your Roth IRA in the current year, you can't just take that money out and then put it back in. So be careful with that. So that's it. These are your two best options for tax advantage retirement accounts. I hope you guys liked the video and learned a lot today. Best of luck in your financial journeys. Peace.